Hey everybody, this is Jose. We are about to start in like 20 seconds. Can I have a quick confirmation? Quick message on the chat box would do for me to know that you hear my voice. I believe everything should be fine, but it's always good to have a quick confirmation before we start, isn't it? I'm gonna turn on the video stream as well so I can be on the bottom right corner. How are you, my friends? 5 seconds to go. How are you, Mark? Good to see you. Here we go. Very good, everyone. We are live. Thank you so much. Maka, how are you? Good to see you, Maka. November 5, 2020, that's today. Options with options, that's the name of the session. So I think the name says it all, isn't it? We're gonna have some fun with options. Since options give us options, we're gonna be looking at different market opportunities and see what's available in the market today in such an important week with the election going on still, isn't it? Before we start, disclaimers. So please read the disclaimer, which I am highlighting right now carefully. I'm counting on you to read the disclaimer completely. It's not so long, so please go ahead and read it carefully. It's important information. So we are in sync from a financial disclaimer point of view, okay, which is obviously an important thing since trading, it's all about money, and therefore there is risk involved, and it's not a joke, especially if you trade real money. So I want to make sure that you guys are prepared, that you know what you're doing. So when you click the button, because it's your responsibility, your actions lead to happy situations instead of problematic experiences. Okay, but anyway, the session is now officially introduced, so we are ready to go. Furman, how are you? Mark, all good on my end. Jose, very nice to see you, Jose. Very, very nice. So let's begin. Guys, so here's the S&P. Okay, so again, parabolic move. The S&P is now up 2.41% as the day started trading a couple of hours ago, actually 3 hours ago. And let me rephrase that, 2 hours ago, exactly, with the recent time savings change, the daylight oh my god, let me say that again. Daylight savings time change. Here we go. Now I said it. I just got confused with the time difference. But yeah, so the market trading for a couple of hours now. The S&P pushing strong to the upside. We are technically in an up climate, as you can see with auto climate here. Obviously, this is some of the times where statistics are less relevant. Statistics are always relevant, but obviously when we are facing such an important fundamental event, such as an election in the US, obviously the climate, which is now pointing at blue and suggesting therefore to continue, actually statistics would suggest that this market could continue up to 12 days, keep moving in the same direction, isn't it? 12 candles. This could change immediately, just like in a couple of hours, if anything else is known about the election and the interpretation of that information is whatever it is, right? So we don't have the power to move the market, and the companies, the institutions that do, certainly they can push it in whatever direction. So it's a time with lots of uncertainty, and more than ever, we have to be careful. Now, when it comes to uncertainty, to be honest, the VIX, it's a great indicator to get to understand the uncertainty available in the market right now. And the last week when we met here in the YouTube channel, we were talking about VIXs around 38 or 37, something like that, where today the VIX is trading at 27. And this is a clear and very objective measurement of uncertainty or fear, which is basically evaporating. Now, VIX 27 doesn't mean it's a low VIX. Okay, again, for the ones of you that are newer to trading options, if I show you a monthly time frame, something quite normal is to get to see VIX values down there for a long period of time, meaning below 20, it's a kind of like a normal thing, or has been. While sometimes we got craziness kicking in and we are above 20, but most of the times, if you were to count the amount of candles, 20 would be a high value. So the fact that currently right now VIX is pointing at 27, it's actually something still quite impressive, and therefore there are opportunities out there to collect great levels of premium. as well as there is a risk involved, or perceived risk out there when it comes to uncertainty risk and so on. If that was not the case, the VIX would be pointing at 15, 12 instead of 27. Okay, so everybody stay careful, be careful. Everybody follow methodologies, don't break the rules, don't bend the rules, don't improvise. Always discipline, no matter what. And certainly 2020, it's been a fun year in many ways for trading purposes. Of course, for other purposes, it's not fun at all. But the fact that the election results are almost now known, and it's kind of like we can see the end result coming towards the end of the week. So we don't want to drop our guard. Our guard should remain in the right place. Okay, so everybody always maintain that philosophy and that healthy mindset. 1.5 hours ago. Thank you for that, Mark. To be honest, I'm not sure how I did the math, but I just got totally mixed up. Anyway, so before we start with looking for opportunities as well, I would like to review 2 trades. One that we have with Merck, which that one is a challenging trade. So if I zoom out and we look at this particular trade, you can see how on the 29th of October, which was prior to elections, we set up a trade using November 20 expiration date. That was an iron condor. We were using calls above, we were using puts below. And basically what we said is that as long as the stock would remain in that purple area, we would be fine. Okay, we would be fine. And statistics suggested that was going to be the case. Why? Because statistics suggested it will not go above 81 from now until November 20. On top of that, we got multiple UFOs that would normally stop that stock from going higher and bring it back down somewhere in the middle part of this range, highlighted with the purple color. But what happened? Well, what happened is that, again, this is a week where things happen with the elections, volatility kicks in, and in this case, Merck exploded in speed to the upside, and basically has surpassed our 81.68. That was the value that we calculated based on probabilities where, that stock was not supposed to go there from now until November 20, but it did. Okay. Now, earlier in the day, okay, if I show you, let me go ahead and go back to yesterday. So November 4. So if you were to look at November 4, notice how we got a couple of UFOs there. And this would make you feel that, you know what? Well, it's been challenging, but now UFOs are kicking in, so it's going to go back down. Okay. Well, notice what's happening today, right at the open. Okay. Again, this is what I meant before. Statistics are statistics, but in cases such as an election week, statistics matter much less. Okay. And even if you were to do statistics based on what happened to other elections in the past, to be honest, every 4 years the world changes. So really, to me, statistics from prior elections are not that relevant at all, because the world 4 years ago and now it has nothing to do. So really, basically, what we are dealing with is a challenging situation with that stock. If you took the trade, this is a challenging situation where the stock could come back down and red UFOs form, and we may end up in the range. It could. But the fact is that from a statistical point of view, if I was to load OptionStation Pro and first look at the P&L I have right now, and second, look at what statistics suggest when it comes to where that stock may go from now until November 20. So this is Merck, it's loading. So first of all, that stock is currently losing $44.50. Okay, that's first reading, which is critical. Second reading, which is problematic, is the fact that it may reach 86. It would actually be a normal thing to happen, that stock actually reaches all the way 86. And if that's the case, okay, that means that we're going to be way above our 85 mark, and therefore we're going to get our full $250 of risk, which is the risk in this trade. Okay, so what can we do in this sort of a situation? Well, option number one, do nothing. Be happy with whatever credit you were going to collect. If right, be happy with $250 of risk. If wrong, and do nothing. And that's it. That's option number one, which, by the way, it's a valid way on how to trade if that's your plan. Okay, nothing wrong with that. In my mind, in my trading style, I do prefer to be more dynamic when it comes to trade management. And therefore, one action that I would see as a powerful action to be implemented right now is to reconvert our iron condor into an iron butterfly. How can we do that? And it's not always worth it to do, but we're going to analyze it today and see if that's worth it or not. So one way to do that would be to go ahead and close the put side, which that put side would be closed for a profit, and then turn around and sell the 82.5 put. Okay, so sell the 82.5 put, and below buy the 80 put, okay, which is $2.5 below. Okay, so we would be left with 85, 82.5, 80 iron butterfly. In this case, it's an iron butterfly because I'm combining calls and puts. You can also use only calls, and that would be fine. But again, just to make it kind of easier to understand, it's kind of like you are pushing higher the put you had below, you close them, and you reopen kind of like the same trade at a higher price point, which coincide with the short strike you had on the call. So it's kind of easier to understand. If we combine calls and puts, well, the risk profile will be exactly the same if you did everything with calls instead of combining calls and puts. Okay, but I'm not going to get into that because that's quite advanced. So let's do it. Okay, so what would happen, okay, if you were to go ahead and take this trade the way it is now, okay, and you were to, let me make some space here. So we were to look at this particular November 20 expiration date, and let me do this. I'm just gonna go ahead and analyze and sell a vertical, and I'm gonna do it twice. Oh, sorry for that. You wanna click there, analyze and sell a vertical. You will see why I'm adding twice, because I want to run some simulations here so you understand exactly what I'm trying to do. Okay, so again, let me disable the one below first. Okay, so let me emulate closing my put values. So if I close the put values, okay, which is sell the 65 and buy the 67.5. Okay, notice what I'm doing here. Okay, so doing this trade is going to cost me 4 cents. Okay, this is going to be the cost of buying the 67.5 put, which is the one I sold. So now I'm going to buy it, and the one I bought, which was the 65 put, that one I'm going to sell it. So basically I'm reversing the puts I have on the top. I'm just going to reverse them, and this seems that it would cost me 4 cents if I was to do that. Now, if I do that, okay, again, if I leave it all on the screen the way I have it, and by the way, notice the one below, it's unchecked, so it doesn't do anything right now in our simulation, okay? So basically, by adding those 2 puts that I just added, I am basically emulating what happens to our iron condor trade that we did the other day, okay, which was like that, right? So as long as price stays in the range, you made $38, and if it breaks the range, you can lose up to 250, which in this case is 250 minus 38, so it's 212. Okay, so that was the risk of the trade, 212. Well, if I close the puts, right, which it's emulated by check marking that vertical spread. Okay, so what happens? Well, right now I remain on on the same level of pain. Okay, I remain at the same level of pain. If the market goes higher, I still have the same level of a loss. Okay, now if the market was to fall, no matter where the market falls, now I'm gonna make my 38. Okay, so I don't have the drop on the risk profile that happens to our iron condors, which is located here. Okay, if I remove the puts, of course that drop goes away. I am basically left in a bear call spread. That would be the risk profile, isn't it? This would be the risk profile of a bear call spread, and that's it, right? So this is what I would have. So in other words, if I do that, basically that first step, okay, so if I take my puts below, okay, the 67.5 and the 65, if I go ahead and I close them, so basically I am left with a bear call spread which is potentially problematic and may give me $212 of loss, while I locked in my profit on the puts, and now even if Merck was to fall all the way, it doesn't matter to me because those puts are not going to hurt anymore since I closed them. So this is what I've done so far, which is not my intention. My intention is to convert the iron condor into an iron butterfly, but first I need to do that, right? So first I need to close it. So that vertical spread I added here, right? It's to emulate what happens to your iron condor if you close it. The second part of converting the iron condor into an iron butterfly, which is what I said, is that now I'm going to take my 87.5 put, which is the same strike as the call, and I'm going to sell. Okay, so let me write it down. So I'm going to add sell 82.5 put, and then below I'm going to buy the 80 put. Okay, that will be an iron butterfly. Okay, which I'm going to do it as a consequence of closing the bottom puts I had. I'm just pushing them higher. So locking in a profit and entering a new collection of strikes, which we said I need to adjust, is going to be 82.5, and buying the 80. Okay, so 82.5 and 80. Now, if I do this, this is going to pay me $1.09. Okay, so I'm going to collect $1.09. So what happens to this trade if I was to do that? Well, what happens to this trade if I was to do that, and notice now I have everything check marked, which means that if I take the iron condor and I close those puts and I sell new puts at a higher strike, technically converting my iron condor into an iron butterfly. So what happens now to this trade? Well, what happens now to this trade is that the risk of this trade goes down, and instead of being $212, this trade now has a risk of $103. So basically I cut in half the risk of the trade. Okay, that's one benefit. Benefit number one, I cut in half the risk of the trade. What is another benefit? Well, another benefit, okay, not everything will be benefits, of course, but another benefit is that now, in a perfect world, if the stock was to end up exactly at 82.5, you would make $142 of profit instead of making $38 of profit, which is what you would have made with the condor. So now your total profit with the whole thing, including the fact that you closed the puts now for a profit and you sold new puts and everything else. So assuming the stock on the expiration date is exactly at 82.5, so you could make up to 142, which is, let's face it, very, very unlikely because the stock needs to be trading exactly at 82.5 on the closing time on the expiration date. Okay, so that's very unlikely. So it's more likely you're going to end up somewhere in between. And again, let's say the stock was trading at 83.43, so you would make $45, okay, which is still more than 38. Let's say the stock was trading at 81.80. So if the stock is at 81.80, so you would make $71, which is also more than 38. Let's say the stock was trading at 81.16. Well, now you would only make $7, okay, which is less than 38. So what's the pro? You can make more, up to 120, right? We said, was it 120? No, 140, sorry, 141. Okay, so you can make up to 140. The reality is that that would be such a coincidence, so it's quite unlikely. But, you know, again, there is room for you to make more than 38 while you have reduced your risk from 212 to 104. Okay, so that is two positives. Okay, that is two positives. What is the negative? Well, the negative is that now, for you to be in profit, the stock needs to be between that price point and that price point, where if I put my mouse there to calculate what is that, so we are talking about 81.1, I'm going to call it 81, all the way to 83, 89, let's call it 84. So in other words, so now the new range that we have where we would end up in a profit, and I'm just going to use green lines in this particular case, so you understand green in this case would mean profit, or yeah, I would actually prefer to use golden. I love to use golden for profits, but with a white background, it would not show well. So let me replace those lines on the chart, and now that would be here, and that would be here. Okay, so 81 to 84. So what's the downside that you can see here now? Well, the downside that you can see is that if the stock goes back to somewhere in the middle of the range, okay, so now instead of making $38, which is what you would make if you were to do nothing, okay, what would happen now is that you would basically end up losing 103, right, on this trade, because this trade would only be profitable as long as you stay within the range set by the green lines. Okay, so what should you do? Okay, what your expectation? What should you do? Right. Well, in my mind, at this moment in time, it would be a right time for you to implement this change. And the reason why I'm saying that is because notice that we have a change of climate. Okay, that climate when starts should last for 7 candles, and if this market is gonna give you 7 daily candles on the way up, so I would say odds are we're gonna be somewhere inside this range at least for the next 7 days, which if you add a weekend, that's 9 days, and therefore it's more likely to be in the upper part than the bottom part, based on what auto climate would suggest here. Why am I pointing at this possibility? Well, because when we initiated this trade, the market conditions for Merck made it show up on our non-directional scanner, meaning that stock had a price action and behavior that was suggesting a non-directional trade to be the right action. But notice how now if I run my scanner, it doesn't show Merck anymore. And one of the reasons why is because that market now is defining a brand new climate, which is pushing hard in a specific direction. So again, with the elections and everything else, could it be that tomorrow the climate is red and now it's coming back down into the range? It could, okay? But again, should I trade based on a guess or should I trade based on objective data? Well, if you are not comfortable trading in front of an election event, then we should not have initiated this trade in the first place. And I do remember commenting on the added risk of running a trade through an election event. Well, I also remember commenting that in my mind, I'm okay with that as a trader. I'm happy to take such a risk. I'm fine. But if someone in the group was to be more conservative, then the right action was not to take the trade. If you are in the trade and you took the trade because of technical measurements and technical reasons, then maintaining and managing the trade should also be because of technical reasons. You don't want to add now hope to a trade that you executed based on technicals, right? So what am I doing? Well, I'm taking a management decision out of technicals. How am I managing this trade? I'm using AutoClimate, which is objectively telling me, hey, this market is now in a different cycle, in a different market environment, and is pushing hard to the upside, and statistics suggest it may continue doing so for another 7 daily candles. So in other words, I'm seeing a higher probability right now based on this objective data that stock ends up higher than where it is right now in the days to come instead of lower. And in this sense, I would see it as a valid action for us to reconvert this iron condor into an iron butterfly. Okay. And by the way, there are other actions that you could implement later on. Let's say it's coming back down. There are other actions. You can do damage control on top of damage control to try to create the same effect where those $212 of risk now become $102.5 of risk. If that market was to fall and you are now in a situation where you may lose that, there are other actions that you could implement to offset that, and again keep limiting the risk. I'm not saying that there is a magic formula where you end up in a profit for sure. That does not exist, but certainly you can keep mitigating that problem over and over again as this problem becomes a problem, which is not a problem right now. Okay, right now we are trading at 81.56, which is between 81 and 84, and therefore we're fine. Okay, So we are not in a problematic situation so far. Okay. Cool. So guys, this was a bit advanced, okay? And I would like to get a little bit of feedback from you guys, just to double check and confirm that you guys followed me. Can I get a little bit of feedback from you guys to confirm that you guys followed me? Yeah, see your comment there, Jose. Yeah, you got it right. Mark, so what are the rules to use to decide to make this conversion? Auto climate, Mark, auto climate. The decision I have taken, the reason why I said it's a good day to do the conversion from an iron condor to an iron butterfly is because the climate it's now beginning in a specific direction, which is the direction of the pain, which is to the upside. Okay, so auto climate. Yeah, cool. Okay, so I guess that we are good. So anyway, we got 20 minutes to go. Okay, and while in a normal case, I would get in a planning trade mode and I would look for other market opportunities. We have Maka with us today, and Maka had questions. So Maka, if you don't mind to phrase your question, I would love to discuss it with you because Maka was wondering about, just like we are doing an active management of an iron condor in this case, so what are a series of actions that you could do to try to offset problems with credit spreads? Am I correct with my understanding of your question, Maka? And feel free to elaborate more if you feel like it. Exactly. Okay, so let's do this. Okay, just to have a scenario, so we can talk about it. So I'm just gonna look at some neutral long opportunity, which is the setups that we'll use for non-directional trades. So let me take a look at Qualcomm, for example. Let me see if that stock was to provide an opportunity. Well, no, way too far. What about Walmart? Let me see. Yeah, well, tough one because earnings, as you can see, so earnings are on the 17th, right? And if I look at next expiration date is the 13th, and then it's 20. So the only expiration date for me to do a credit spread on Walmart would be to use the 13. And if I use the 13, then I'm limited on how many more things I can do if the market was to move against me. But so I'm going to do something that I'm not supposed to do, okay? And please do not take the trade I'm about to plan because it's going to be planned in a wrong fashion on purpose. So I can answer Maka's question, but make sure that you understand that this trade will not be executed this way. Okay, so I'm gonna plan a trade on Walmart using November 20 expiration date, which is after earnings. Okay, so don't do that. Okay, but I'm gonna do it. So I got 2 weeks. So I tell you things that you can do with the week in between. Okay, in case the market goes against you. Okay, I need a bit more time to be able to give you more choices on things that you can do. Apart from using a hard stop, there are other possibilities that could be interesting to you. Okay. So how would you do a credit spread on Walmart? So speed of the light. So you would load Walmart. Okay, you would look at November 20. So right click, analyze and sell a vertical spread. And this is telling you using November 20, that stock may drop all the way to 134. So let's see, where is 134? So 134 is somewhere here. So it would make a lot of sense to be using the 132s or the 132 and a half, depending on what's available, to do a credit spread and sell options below that price value, which is using UFOs with 54% probability and is beyond what statistics or probability would suggest, which was 134, isn't it? Here we go, 134. Normally I use a dotted line, isn't it? So I'll make it dotted. So it's same look and feel of what I normally do, even though we're not going to execute this trade, okay? So let's say I'm going to do this trade. what do I have available when it comes to the 130 something? So I got $1 strike price increments, which is beautiful. So let's say I'm going to do 132. So let's say I do 132 and 131. Well, that will not work. It's only 10 cents, but let's pretend it does. Okay. So let's say I'm going to do 132, 131. Okay. That would only provide a credit of 9 cents. That's not enough for us to accept. But again, for simplicity, let's pretend that you are happy with that and you take this trade with X amount of contracts. Okay. I'm just gonna be generous. Let's say you did this trade and we were paid 20 cents. Okay, I'm just making this up. Okay, guys. So let's say you got paid 20 cents. That's your credit spread. So if you're right, you're gonna make $20, and if you're wrong, you're gonna lose 80, which is the difference between strikes, which is $1 minus the 20 cents. That's 80 cents times 100 is $80. So you have a credit spread where if wrong, you lose 80, and if right, you make 20. Okay. Everybody with me so far? Again, this is a made-up trade. This is not a valid trade in any way, but let's pretend it is for me to be able to answer. Okay, cool. So now, what to do if this market goes against you? Okay, so, well, again, option number one, from more simple to more complex, do nothing. Okay, why do nothing? Well, because the most you can lose is 80. And if you're happy with that, so that's it. You know, your worst case scenario is going to be 80, and that's it, right? Also, doing nothing could be smart because, you know, let's say you have more UFOs below. Like in this case, you got another UFO below. Well, so this market could certainly go for the next UFO and then come back up. And, you know, if you exit the trade, you end up locking in a loss, where in the end, you could have ended up in a profit thanks to that UFO. So again, doing nothing could make sense depending on your trading plan, trading rules, way on how you assess the market, what you know about trading. You may have a reason to do nothing, and it could make sense because that market may come back before the expiration date if the setup was to suggest so, and you may end up in a profit in the end. While temporarily you are in a loss, you end up in a profit. So doing nothing, it's a valid choice, assuming it's part of your plan. But I do want to understand Maka's question with avoiding the max loss, because if you think about the max loss, I mean, while it's called max loss, in this case, the word max, visually speaking, and probably you're coming from there, Maka, the word max to me should be another word, should be the word pain or something like that, because when you compare the amount of money you're going to lose if you're wrong versus the amount of money you're going to make if you're right, there is a very, very, very big difference. Okay, very, very big difference. I mean, we see that often as well with iron condors and things like that. But again, with iron condors, you sell double the options, you get double the premium. The range is wider because you get double the premium, so the range is wider. So probability is more. So it is more, if you wish, justifiable to assume such a loss, especially knowing that with an iron condor, you can go ahead now and turn it into an iron butterfly, and now you just cut by half the risk. And you can do fancy things that could certainly help the risk management of your executions. But with a credit spread, you know, if you were to just wait and do nothing, that max loss, it's really painful, right? 80 versus 20, it's just like, you know, some of you may be thinking, why would you even take this trade, right? And I could understand that thinking. So what could you do? Okay, well, a classical action, if you were to be in this trade, is to set yourself a maximum amount of loss that you want to take. So for example, if the most you're going to make is 20, you may say, okay, I want to keep, I read in most of the trading books that you find in the world, they will tell you about 3-to-1 relationship between risk and reward. So you may say, if the most I'm going to make is 20, so then the most I want to lose is a third of that, which is $6.06. Let's call it $7. So if this credit spread ever trades at $27 or 27 cents, get out. So you could have a hard stop based on the premium. Now, this could work very badly, especially if you have an increase of implied volatility, where maybe that stock is still trading at the same price. Okay, maybe the stock is trading at the same price. Okay, so the stock is currently here, and maybe the stock drops a little bit or rallies a little bit. Not a big difference. It's still more or less in the same area, but next thing you know, something's happening out there when it comes to the interpretation of the election. Something is happening out there when it comes to the unemployment number. Today's Thursday, maybe next Thursday, maybe any other time when there is the earnings. Not the earnings, the unemployment rate, which is once a month on the first Friday of the month. Whatever. And next thing you know, implied volatility jumps. Next thing you know, the value of the option increases, hits 27 cents. You get stopped out, and the stock is still in the same place, or kind of in the same place. So that could play poor for you. So that could be bad. Another possibility would be to set a stop below a UFO. That would be quite smart, actually, especially given the fact that the climate is up. That UFO is likely going to work well. Okay, and you could have a stop below, and if price comes to the UFO and then rallies out of that, so you never been stopped out, and you ended up making the profits on your credit spread. So that would be good. But I'm not a fan of that either. And the reason why I'm not a fan of that, it's because we always comment in the sessions how stocks are a fragile asset. And this is often misunderstood, especially if you're new to the sessions and you hear me say stocks are fragile. You're going to be like, wow, what are you saying, Jose? Don't trade stocks? No, that's not what I'm saying. What I'm saying is that stocks are an instrument that, while they are beautiful to trade and certainly a good product, they only trade 6.5 hours a day. And you got 9,000 stocks, almost 9,000 stocks in the whole US market. While even though the US market is the largest in the world for equities, equities is a small market compared to futures, for example. It's like 3 times smaller. So if you think about equities being 3 times smaller than futures, and you got 9,000 stocks, so how relevant is each stock by itself? Well, not so relevant, right? I guess it's common sense. So how often those UFOs could fail? Well, you see those values, 54% in this case is actually very nice for Walmart. Many other stocks, let's take a look at Facebook, for example. Okay, Facebook has how much? 51%. Let's take a look at Coca-Cola. Coca-Cola has what? 56, but it's still pending data. Let's wait. Come on. Maybe I should have picked another stock that was already loaded in my computer, so we don't need to wait for the loading to take place. Okay. So maybe I'll do that. I'll change to another stock. Let's try Johnson & Johnson, for example. So with Johnson & Johnson, what happens? We got still pending data too. Okay, great. I guess that I cleaned my cache folder not too long ago and I didn't load that one. What about Merck? Okay, so Merck has 54%. Okay, which is, all of those stocks are pretty good, which is the ones we have been trading, right? But there are other stocks, okay, that were not so good. Okay, what about I don't know. I'm just thinking. Just got blank for whatever reason. So what about Royal Caribbean? So what happened with that particular stock? Well, we need to wait for the pending data because 62% is certainly not a normal thing on stocks, as you will see. I'm gonna go back to Coca-Cola. Maybe it's loaded now. So Coca-Cola, 50%. Okay, so you saw 53, 54, 51, 50. Now, if I show you the S&P futures, for example, which is a 24-hour market, so what's going to happen? Now it's 62%. So much more, right? Why? So much more relevant. Larger market, trades 24 hours a day. So again, it's a very, very, very big difference. Is that making sense? So back to Walmart in this example where we are discussing a credit spread. So that's what I mean when I say stocks are fragile. So setting a stop below a UFO, it's a problem because often, given the fragility of stocks, you could have a little bit of a tease below the UFO and then goes back. Why is that? Because the real turning point on the stock may happen because a stock, which is a competitor stock to Walmart, maybe it's Target, maybe it happens because of the sector, maybe it happens because of the S&P, and you had to wait for the whole S&P to turn for Walmart to follow, because Walmart by itself cannot turn the whole broad market or the sector or all the competitor stocks. Is that making sense? So setting a stop on your credit spreads based on UFOs or price points on your charts, setting a stop on your credit spreads based on the premium itself, to me, it's not efficient. Based on my rationale, I guess you would understand. So what I would do is I would set up some sort of a rule on my trade plan for the credit spread, where if that stock was to go below a certain price point, which could be set by a UFO, for example, so then what I would do is I would enter a hedging trade. Okay, and what a hedging trade could be, okay, it could be using shares of stock against the credit spread. But the problem is that stocks got delta but flat gamma, and credit spreads always got negative gamma. So a stock would not help with the negative gamma. So if I was to get into a short stock position with X amount of shares, so for example, let's say I want to hedge this credit spread now with minus 10 delta. So I can go short 10 shares. And if I go short 10 shares, okay, my net delta is going to be flat. Okay, so take a look. If I analyze and sell shares, okay, if I analyze and sell shares and I do minus 10, so what happens to where is it? Why is it not? Oh, here. Interesting. I'm not sure why it's showing minus 8. Oh, yes, of course. Yes, I was doing the math wrongly. Sorry for that. So if I short one share, notice what's happening to my delta. It becomes flat. So you will be like, okay, so now I'm hedged. If the market keeps falling, I'm not going to get hurt. But yes, you do get hurt because of the negative gamma, as the market keeps falling from 143 to 134, notice that you keep picking up delta. Okay, the delta increases and becomes more positive. So somehow what I'm doing by shorting shares is softening the pain curve. But if the market keeps falling, notice how I could still end up losing $60 instead of 90, which is a little bit of a help, but I'm still losing. Okay. Now you may say, okay, that's good enough. I'm reducing some of the pain. Okay, great. Glad to help. But what's the problem? What if the market goes back to go up? Well, if the market goes above 162, which let's face it, is unlikely, but it could happen. What happens? Now you end up being right, but now you end up losing money. So you could use shares of stock against your spread, and that could help a little bit, but it's not gonna fix the problem with the negative gamma that credit strategies always have. So what could be a better way to hedge? Well, in my mind, it would be to use some of the credit. Okay? Use some of the credit. You collected 20 cents in this made-up trade, right? So go ahead, using a shorter expiration date, go ahead and buy yourself a spread below price. Okay, so analyze a vertical spread. Buy yourself a spread with a shorter expiration date. Okay, the one above is using November 20. The one below, the one with the blue color, which I'm analyzing now, is using a shorter expiration date. So go ahead and buy yourself a spread with a shorter expiration date. The current price is 140 something. So you could go ahead and do this much higher. So maybe I can do that using, let's say 140. If I do 140 and I do 140 and I do 139, for example. So how much this is going to cost me? So this would cost me 18 cents, which it's almost everything I make on the credit spread. I would pay it to buy this one. Okay, so maybe you can go just a bit lower. So I'm going to do 138, 139. Now it's going to cost me 14. Maybe you want to spend half of your credit for the hedge. So you go a bit lower, 137 to 138. Now it's going to cost you 10 cents. So now you can have a spread. Okay, you can have a spread where notice what's going to happen now. Okay, you ended up with converting a negative gamma position to be positive gamma. So now if this market falls, you actually pick up negative deltas. So you make money on the way down. And if the market rallies, you stay kind of flat. So notice what happens. From the current point, you stay kind of flat, right? And now if the market falls, you start making some profit. Okay. That to me would be a much better way on how to approach managing the risk of a credit spread, where you are giving up on half of your credit. In this case, instead of making 20 cents of credit, you are giving up half of that to pay 10 cents to buy the hedge. But now the beauty of the hedge is that it kind of guarantees the profit to the upside if the market moves the way you want it. But if the market moves against you, you can still make some money. Okay. Now, of course, now your duration for this trade will not be November 20 anymore. On November 13, you will need to close the trade and be out. Okay, so that would be another way to approach it. And again, in this case, the risk profile is looking very powerful because remember, I made up my entry value to be 20 cents. Okay, in the real world, it's not going to be so positive. It's going to be a bit higher. You may get a little bit of pain, but it's going to be so much lesser than $80 of risk that the original credit spread has by default. Okay, so again, damage control for a credit spread. Yeah, exactly. Yeah, I don't know how I did the math, Jose, with the delta, but basically, it was not important really when it comes to utilizing the stocks because stocks got no gamma. They have delta but no gamma. And what I wanted to do is I wanted to reconvert a negative gamma position to be positive gamma. That was the trick. That's where now you add a dynamic impact on the hedge that will produce a much better result. Okay. Now again, all of this is not always possible to adjust in such a beautiful way. Maybe when it's time to hedge, too much time has passed and you don't have another expiration date in front of you. So then you have to get out of the trade with a stop, or you have to take a decision based on your plan. So again, there is no magic formula where you always end up in a profit. Okay, that would be. I would love to teach you that, where you always profit, right? It's not like that. Trading is not like that. But certainly, this is a much more evolved and original way on how to deal with hedging a credit spread. I see people go crazy with some techniques on how to hedge spreads, where basically they do those trades that are almost impossible to lose because you sell spreads so far away, which is crazy. But then because it pays so little, you end up doing this huge amount of contracts where most of the times it's very powerful and works very well. But that one day where it fails, it's such a problematic situation. And then it's all about trying to fix the problem in the middle of the problem and getting emotional because such of a large position. And I've seen a lot of traders make a lot of money for a long time and they just destroy their accounts and their self-confidence in one day, right? And again, these are in my mind much more elegant ways on how to protect a position without having to fall into what I would call hope or desperation, which I've seen that happen to people with a lot of experience. And again, it's because sometimes experience leads to overconfidence. We never want to fall into that, guys. Okay, and I have felt myself into that. Okay, because I'm human too. But that's why I'm sharing this lesson with you guys, so it doesn't happen to you. And if you enter a hedge and you don't touch it, you are less likely going to get emotional. That if your hedge is enter shares, rectify the shares because delta has changed because of gamma, close the hedge, re-enter the hedge, you may go crazy by doing that. And this way, it's a pretty easy one. Okay. Yeah, Mark, using micro minis against a credit spread done in options on futures, it could certainly be a valid way to do it. But again, micro minis have no gamma, so it's equivalent to using shares, right? We're using debit spreads against the credit spread using different expiration dates could be a more elegant way on how to do it. Okay, cool. So anyway, my friends, it's time to conclude the session. Maka, hopefully this was a satisfactory answer to you. Let me know if that's not the case. Certainly happy to keep discussing these. Options give you options, isn't it? So there are many things that could be done. Yeah. Jose, I'm reading your comment about trying to hedge and losing a few bucks. Again, as long as it's only a few, then the hedge did its job. Okay, because the hedge is not a magic formula that always end up in a profit. Notice here, there is a little space where you would end up under this line, right? So there is risk. No matter how you hedge, there is always risk. Hedge equals reducing the risk and putting you in a more advantageous position where you may end up profiting. Hedge doesn't mean remove the risk. Okay, that's a wrong interpretation of hedge. Sometimes we talk and we say it quickly, and because we are traders and we are human and we hope to remove the risk, so we kind of interpret that hedge equals remove the risk. Well, that would be amazing. That means that you have no risk, right? So why don't you hedge from the beginning? So now you have no risk ever. You never have risk, right? So I mean, I know you didn't get it this way, Jose. I understand that you understand what options are all about. So I get you. But at the same time, I wanted to phrase it for the ones of you that are newer to trading or watching this recorded, so you understand and you get my point, okay? Yeah, so as long as the technique you applied was getting you in and out with some activity, you kept emotions under control, and you ended up losing a little, then it's fine. This is a very passive way on how to hedge, where the moment you enter it, the only thing left to do is that instead of waiting to November 20, you have to close the whole thing on November 13. Okay, that's the only difference. So there are two steps: hedge and then close ahead of time on the 13 instead of the 20. That's what it is. Okay, cool, very nice, everybody. Always a pleasure. I'm just looking at your messages, guys. Time to close the session. Time to close the stream. See you next time. By the way, even though I just said time to close, let me bring one more thing here. Tradewithufos.com. Important, guys. Tomorrow we have a new session for the first time in the YouTube channel. We call it Solid as a Stock with Becky. Don't miss it. Okay, it's going to be about stock trading, obviously. You're going to have the opportunity to experience working with Becky as well, who is an incredible trader and coach. So don't miss your opportunity, and meet Becky tomorrow, same time, same place. You guys take care. See you soon. Bye-bye, everybody.